out of this.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Thursday, second best day of the week. And yesterday, of course, we had a bit of a sell-off in the market. I know that seemed a little bit disappointing, but as we'll talk about when we do our Before the Bell segment, so as we had discussed yesterday, these trap longs that were kind of in the market. You know, they all woke up on Monday down 3% in their portfolio. I was like, oh my gosh, what's happening here, right? Got to, look for an exit. And so as soon as the market bounced back to the 100-day moving average, that's exactly where they decided to all take the off-ramp yesterday. So we'll talk about that this morning. Of course, Michael Leibowitz joining me today. We've got to talk a little bit about the Fed. Will the Fed cut rates in September? What's the probability of that? What does that mean? Because we had talked about, previously that the economic data still doesn't really suggest a recession yet. Yes, certainly weaker, right? No doubt, the recent employment report, weaker than expected. Some of that had to do with Hurricane Beryl that hit Houston in the month of July. And then, of course, now we've got Debbie that's going to cause some problems to the employment numbers in Florida. So we're going to have a couple of months here where these employment numbers are impacted by these kind of outside events that may or may be kind of affecting that total number. So maybe the jobs numbers aren't as weak as they are, but nonetheless, they're still above 100,000 jobs. So it's not recessionary, right? We're not printing negative 100,000 job employment. So the data, and again, we saw ISM services on Monday. One of the reasons that yields have been pulling back this week is that the inflationary data, it's still there, right? Services is 80% of the economy. That came in stronger than expected, still showing expansion. So that's economic growth. Again, so that, yields had gotten really kind of run up on this, kind of on that last employment report, had a big jump in yields, 4% on Friday when that employment report came out. So basically reversing that a bit as maybe this data isn't as recessionary as that employment report showed, right? So again, so this is the challenge that we're going through right now. And of course, this is also the Fed's challenge, right? Do they cut now? Do they cut aggressively? We've heard Fed members coming out over the past couple of weeks talking about, got to cut rates now, need an emergency rate cut, et cetera. And that's probably not going to happen here. So again, what we've got going on right now with the markets this week in particular, and look, it's been a very volatile week, no doubt about that, is this unwinding of this carry trade. We wrote an article on Monday. It's on our website about the yen carry trade. We touched on it in our daily market commentary as well. So if you get our daily emails, we've discussed that there. Also had a video out on this page, on our YouTube page. We had a video out earlier this week talking about what a yen carry trade is, but that's what's been going on this week. That's the volatility. It really doesn't have much to do with the recession. This has everything to do with a lot of global margin call on big hedge funds that had to unwind that. Now, JP Morgan out with a comment this morning. They think that we're about 75% of the way through the unwinding of that carry trade. So the good news is that this push of selling that's been occurring in the markets this week, and again, this is kind of what we talked a little bit about yesterday, is that this push of selling is likely exhausting the sellers. We had this big run of sellers into the markets initially. That's what caused that big sharp drop off on Monday. Had a lot of investors had to sit back, couldn't really trade into that thing. We had to wait for a bit of a rally here. So they're now exiting, right? We saw this over the over yesterday in particular. May see some more of that today. But this is very similar. This type of activity is very similar to what we've seen during previous market crashes, 1987, 2011, 2015, 2018. These are good periods that are reflective of what we're seeing going on right now. These are these exogenous, unexpected events that are one-offs. These really aren't, this isn't a valuation issue, this isn't an earnings issue, this isn't an economic issue, this is a one-off event. 1987 was portfolio insurance. Basically, when there was a realization that portfolio insurance didn't work, all those options kind of went haywire. We had a very, very sharp drop off, about 20% in 1987. The market then kind of very quickly bounced, rallied a bit, came down, retested previous lows, then we continued on with our lives. 2011 was the Japan issue, right? We had an earthquake that caused a tsunami that flooded Japan, that caused a nuclear meltdown that launched Godzilla. And that led to a shutdown of manufacturing that impacted the economy very short term. But the markets very quickly got past that. 2015, Janet Yellen's hiking interest rates basically says, hey, we're done with QE. We're going to hike rates and taper. And then also we had Brexit occurring at the same time, an unexpected event that weighed on markets short term. We went through about a month or so of volatility, then the markets took off again. 2018, the Fed's hiking interest rates into September. The Federal Reserve says, hey, we're nowhere close to neutral, not anything the market was expecting. Market sells off 20% before the Fed reverses policy. So again, we have these kind of unexpected events that shock the markets temporarily, but those markets tend to respond, price that in, and then begin to move higher. That's a little bit about where we are right now. So looking at those previous periods, and this is what we talked about yesterday. So here's what you need to know before the bell, by the way. As we talked about yesterday, this correction actually started. This correction didn't start on Monday. This correction started back on the 15th of July, where the market peaked. We began to sell off, fairly normal sell-off in the markets, nothing really exciting too much. Came down, took out the 20-day moving average, held support at the 50, challenged the 20 and failed. And then when we failed at the 20-day moving average, that's where the market began to really experience these sell programs, and we began to see the impact of this unwinding of this carry trade beginning to happen. And it happened very quickly. So we crashed through the 50, the 100, and was approaching the 200-day moving average. We haven't quite got there yet. But then we said yesterday that don't be surprised if we see this kind of, or we said on Tuesday, don't be surprised to see a reflexive rally here, challenge this 100-day moving average, and then these trap longs, these people that got swept up into this sell-off, don't be surprised to see them hit the exit button. And that's what they did yesterday. The market rallied right into the 100-day moving average, briefly poked above it, but then sellers showed up and basically had selling all afternoon yesterday as they sold off, and markets ended at their lows yesterday. So again, kind of expect a little bit more of a sell-off, potentially today or tomorrow. But we're getting through most of the selling pressure. Markets are getting fairly deeply oversold here. We're exhausting sellers at this point. Sentiment's turning much more bearish, which is what we needed. So we're reversing a lot of this exuberance that we had in the markets. So as we reverse that exuberance, that's going to give us a better opportunity to potentially see where this market bases and stabilizes, and we'll kind of know if and when we've got a market bottom put into place. One other thing we said also is to pay attention to bonds. This is bond price, not yield, but bond prices got just shot off through the roof on concerns about recession, right, from that employment report that was a bit early, very kind of overly exuberant. And we noted that we would have, we said earlier this week, we said, don't buy bonds here. It's too late. If you're not in bonds, you can't buy them here. They're too overbought, too extended. We're now working that off. So again, we would expect to see bond yields kind of come back, or bond prices to come back to basically the support in this cluster of moving averages that we have right here. That's about 4.1% on the 10-year Treasury. We were about 3.95-ish yesterday. So we're getting back there. We've got a little bit more work to do here. We're not oversold yet on bonds, so we don't quite have an entry point on bonds, but the bullish setup for bonds in general has become much better recently. And as the Fed cuts rates, that will continue to put downward pressure on yields and push bond prices higher. But it's not going to happen overnight. It's not going to go straight up. This is going to be kind of a grinding process here for a while. So that's what you need to know before the bell this morning. Lots of stuff to talk about with Michael Leibowitz when we come back from the break. So don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome to back to the show this morning. Michael Leibowitz joining us all the way from his undisclosed location. He's over there by D.C. Won't tell you exactly where it is. We have a lot of people from all around the world this morning. Melbourne, OBX, Europe, Rhode Island. Thanks for showing up. We appreciate you being here. Long travel to get here this early in the morning, but wonders of the internet. So a couple of things. First of all, this morning, Eli Lilly just announced earnings. Full disclosure, we own shares in Eli Lilly. And a very interesting kind of dichotomy between Eli Lilly and Novo Nordisk, which is the other semaglutide producer. So these are these weight loss drugs that have kind of taken the world by storm here as of late. And, you know, it's interesting. Novo Nordisk yesterday had very disappointing results in terms of their earnings. Stock was down a bit yesterday. Same type of drug on the semaglutide front. Eli Lilly this morning just really blew the doors off. Obviously, the weight loss drug is working better for Novo Nordisk's earnings than it is for, which, you know, for Eli Lilly, because their earnings are getting a lot fatter and doing well. But those shares are going to be up fairly sharply this morning, so that's going to be one of the bright spots kind of in the overall market today, as those drugs continue to try to gain a foothold here in the States. Speaking of earnings season, it's been really pretty much a mixed bag. Not surprisingly, companies have mostly beat earnings. The number of companies beating estimates were over 75%. So as of last week, we've got about, as of tomorrow, we'll have basically 84% of the entire S&P 500 will have reported. So most of the major companies have reported. NVIDIA won't report until next month. They're very late in the cycle, so we'll get that kind of later on. But outside of NVIDIA, for the most part, every major company has now reported earnings, which opens up the buyback windows. So we are very close to having about 90% of all the buyback windows reopened, because as soon as the company announces earnings, they can start buying back stock. We saw quite a few companies announce to increase buyback programs or starting buyback programs, et cetera. So again, this is going to be one of the buying catalysts for the markets. This is the one thing that where people are expecting the next great crash, kind of the end of the world, markets are going to be down. You can't discount the importance of corporate share buybacks, which is not a new phenomenon, but at the level at which we're doing them now is new. And that's been about over the last decade. Corporate share buybacks have become a very large chunk of the net asset purchases since 2000 in particular. Corporate share buybacks have accounted for 100% of all net equity purchases. So if you take all the buys and the sells, strip those out, institutions, pension funds, retail investors, et cetera, corporations have made up 100% of the net equity purchases in the market. So one of the things that keeps supporting the markets, and one thing that will continue to support the markets in the future, are those buybacks, because they provide a buyer of those shares, so which keeps market prices elevated, keeps valuations elevated. And so this is one of the things I think a lot of people discount. They look at the market and say, well, valuations are this, and that means the markets are going to have to do Y. This is X, then the markets have to do Y because of X. Doesn't mean that can't happen, but you can't discount the importance of this buyer that's in there of mass proportion. Apple alone will make up more than 10% of all the net share buybacks this year, just to kind of give you some relevance. Even Berkshire Hathaway is buying back shares. Michael Leibowitz, welcome to the show this morning. How are you, sir?
Good. How are you?
Good. So let's talk a little bit about the Fed. They certainly have an unexpected event on their plate to deal with in terms of, kind of thinking about, the economy and rate cuts and those type of things. Obviously, this week, this kind of yen carry trade was not, maybe have been on the radar a bit, but probably not, and on the bingo card, so to speak. Right. But something they certainly have to consider now because of the potential impact to consumer sentiment. If market prices decline enough, that impairs consumer sentiment. If consumer sentiment gets impaired enough, people stop spending. That slows the rate of growth in the economy. Kind of has a feedback loop on employment and inflation and everything else. So they've got to be aware of that and certainly cognizant of what a sharp unexpected decline in the market can do to confidence and what that means potentially for monetary policy. So any kind of takeaway this week from kind of recent Fed statements, the recent Fed meeting we had, do you think this changes anything in terms of rate cuts coming in September?
You know what? I think in some respects, it probably pushes the Fed to want to do more rate cuts. But at the same time, the situation says that you should be doing less rate cuts. And what I mean by the situation is the unwinding of the yen carry trade. And that yen carry trade has been so obvious over the last week. And actually, we've talked about it for 3 weeks because we've seen little glimpses of it. Mm-hmm. It just finally hit its full stride over the past 4 or 5 days. And the cause behind the yen carry trade is ultimately when people do the yen carry trade, what they're really doing is borrowing in yen, selling the yen, buying dollars, and investing those dollars with a lot of leverage. So bottom line is, whatever they're long or short on the asset side that they've decided to buy, they're short the yen. And that trade works when the yen is going nowhere versus the dollar or it's depreciating versus the dollar. When it's depreciating versus the dollar, you're making money on that side of the trade too, in addition to whatever you're making or losing on the asset side of the trade. So for a long time now, the yen has been depreciating. It's down roughly 40-50% over the last few years. So think about that. If you've been in the yen carry trade, forget what you bought. Even if you bought T-bills, you've been doing really well just because of being short the yen. Well, a few weeks ago, the yen started rallying. And why did it start rallying? Because there was rumors and discussions at the Bank of Japan that they were going to raise rates, which is what they did last week. And that's now the second time they've raised rates. Also on Friday, we got the unemployment report, which was weak. So it pretty much cemented that the Fed was going to cut rates at the upcoming September meeting. And the issue you have now is that the interest rate differential between Japan and the United States is shrinking, making their currency appreciate, ours depreciate. So Jeremy Siegel, famed economist, famed buy and hold, famed bull all the time, no matter what, came out and said, this is on Monday, on CNBC, the Fed should immediately cut 75 basis points and then at the next meeting cut another 75.
And did he give a reason? Did he give a reason why he was wanting such drastic rate cuts?
He said in part because the Fed has to stem this weakness in the labor market before it gets out of control, and two, because of the financial markets. So what he doesn't seem to understand, I think what a lot of people don't seem to understand, is that if the Fed were to have followed his actions, the yen would have gone to the moon, because that rate differential would have shrunk significantly, and the expected rate differential would have as well. So, the Fed, basically, there's a long, long way of saying the Fed's trapped. Not necessarily trapped, but that there's things to consider on both sides of the equation. If they do cut rates, they have to deal with the yen side of it. If they don't cut rates, there's a growing concern that we are closing in on a recession, and the longer they wait, the more they're going to have to do to try to stem that recession. So it's not, the Fed will, I'm pretty sure the Fed will cut rates in September, but it's not clear cut that the Fed is going to be gung ho and trying to save markets if they keep declining with rate cuts. My guess is currency intervention by both us, the Bank of Japan, and probably other central banks will be what intervention looks like, at least over the next, call it few weeks or even few months.
Right. And again, this is, not surprising, by the way, that the Fed is kind of caught in a trap a bit, because they're generally caught in a trap one way or the other, because they're reactive and they respond to actions in the economy rather than taking action to precede, the ultimate outcome. And you and I talked about this before, is that, during the pandemic shutdown, they responded appropriately by cutting rates drastically and doing QE, right? So we knew that. And then at the same time, the government started sending stimulus checks into the economy. Well, if Jerome Powell would have had some forethought here, what he should have done is saying, oh, great, the government is stepping in with a fiscal response, sending checks to households. That'll help support the economy, but that's going to create inflation because we shut the economy down, but we're going to get people to spend money. So I'm going to start hiking rates a bit here, come off of zero, hike rates now to try to temper that impulse of money coming into the economy. I'm going to cut QE at this point because I need to again, offset that, or be a counterbalance to that influx of monetary stimulus. And had he done that, yes, the market wouldn't have rallied as much as it did, but we may not have had 9% inflation either, because there would have been a tempering to some of that activity. Go ahead.
Lance, in the summer of 2021, he was begging for more inflation. He said the inflation rate is below 2%. We need to get it up to 2%, and we'd be okay with a period where it trades where it is above 2%.
I don't think he meant 9.
No, this was when inflation was really rooting and getting ready to set off.
Yeah. Again, exactly to my point, Mike, is that they're reactive, not proactive. And so, again, not surprisingly, they're behind the curve here. We'll come back, pick up on this conversation on the other side of the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Now, I warned y'all about the chat rules. Our chat member, Jerome Powell, says that I'm old enough to remember when we used to use well oil for fuel.
Those are fighting words.
The Real Investment Show podcast.
Them's fighting words. But more importantly, what Jerome Powell doesn't understand is that I remember when we had to catch our own whale.
And then turn it into oil.
And then turn it into oil for fuel. So, I mean, that was back then when men were men.
We liked it.
At realinvestmentadvice.com.
Had blubber for days.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So if you're in our chat right now, if you have a question for Mike, if you'll put it in there, we'll try to squeeze them in here into the last half hour of the show. Got a couple already, but one of the questions we got was any thoughts on the Sahm Recession Indicator. So I recently just posted an article on our website. So if you go to realinvestmentadvice.com, click the Insights tab, go to the daily blog. It was last Friday, we posted an article about what the Sahm Rule is and go through kind of the employment numbers. Even Claudia Sahm right now herself is not suggesting that the Sahm Rule, which has been triggered, is indicating an imminent recession. There's numerous reasons for that, but yes, unemployment is rising, but there's also been some, as I said, Hurricane Beryl, et cetera. Those are creating some anomalies to the data that, may be kind of skewing some of that data momentarily. Furthermore, we're still printing positive numbers, and jobless claims remain fairly low. So from her own perspective, she's saying, hey, doesn't mean that the Sahm Rule won't be eventually correct, but it doesn't mean a recession has been triggered today. And that's the important thing to remember, is that a lot of these indicators have long lead times. Fed rate cuts always occur prior to recessions. It's about 9 months between the first rate cut and the recession. It typically tends to be about 6 to 9 months, kind of on the longer end. So again, it's just important to remember that recessions are backdated. So by the time the data comes through, and the National Bureau of Economic Research, who is the arbiter of recessions, once all that data comes in, it gets revised, then the NBR comes in and says, okay, the recession started here. And that can be anywhere from 6 to 9 to 12 months after the recession's already started. So, it's very difficult for individuals because it's like, oh, this is always means there was a recession, right? So inverted yield curves, right? We've talked about this. Inverted yield curves, when they uninvert, that's when you have a recession. Leading economic indicators, 6-month rate of change, always predicts a recession when they're at their current levels. Employment numbers, all these type of things. We go back in history and we look at a chart and we say, well, see, every time this happens on the chart, there's a recession. The problem is that gray bar of the recession didn't show up until about 9 months after that event occurred. But when you're looking on a chart, it looks like, oh yeah, this just happened. That means we're in a recession. Well, we don't know that yet. And the markets don't know that yet. So you always have to remember there's this big lag effect to that. Mike, your points?
No, that's exactly right. We're just as guilty as everyone else. We show charts with we show charts with just about every recession, and at the end of the day, those dates are wrong, right? I mean, that may be when the recession started, but when it was declared a recession could have been 6, 9 months, even a year later. So you're in this environment today where we could be in a recession today. We're probably not, but we won't even know for 9 months. And what we'll see is whether the economy continues to weaken, or again, like we've continued to say, are we just normalizing? Are we getting that plane down to a regular flying altitude? And that's why we're so closely watching all these numbers, right? And it's not just the BLS employment number, the weekly jobless claims, the JOLTS data, all the labor data we can get, whatever the services and manufacturing PMI data tell us, what we just saw from earnings, retail sales, what retail companies are telling us in regards to sales. So there's just tons of data. At any one time, the data conflicts with each other. There's never, data doesn't just flash, we're going to have a recession, it's over. And my latest article is on confidence. And confidence is part of that whole equation, yet it's so very difficult to quantify. So confidence is basically what drives us to consume or not to consume. It's kind of that marginal driver of consumption. If you see your neighbor get laid off or one of your colleagues get laid off and you're starting to question how good the economy is, you're going to go out to dinner a couple less times in a month or two. You're going to not go to the movies. You're going to say, you know what, we can wait a few more months before buying the car. And it only takes a little bit of a small number of consumers to just kind of tighten up on their wallets, and you can have a recession, or you can certainly have a deep slowdown. And that's the problem. So what concerns me a little bit is what just happened this last week with the stock market. Is that changing people's opinions? I had a couple friends asking me what was going on. They noticed that their 401k stopped going up every week. That the 401k, I think, is a lot of people's gauge of the economy. Mm-hmm. And when that starts dropping, they're like, what's going on? Are we going into recession? They know that the economy is stretched, that we've seen a lot of growth, and it's due for some sort of pullback. But, again, until consumers really start pulling back and corporations start reacting, you're not going to have a recession. And we're just going to have to wait and see to see how consumers are reacting to what we just saw. And that's why the Fed and everyone else wants to get the market kind of just back on even keel. Doesn't mean they need it hitting new highs. They don't need it dropping 3 or 4% a day, because I guarantee you, if we do what we did on Monday for a few weeks straight, confidence will collapse and we will have a recession. Mm-hmm. So it's kind of a chicken and the egg story between confidence and the economy, which makes it hard to gauge. It's very dynamic between the two. One quick point on that, Lance. Mm-hmm. There's an old saying that the stock market leads the economy by about 6 to 9 months. And if you go back and look at graphs, sometimes that's true, sometimes that's not true. But the thought is interesting that you basically assume that the stock market investors are sages and they know that when there's a recession coming. Maybe that's the case. But what more likely is happening is that the stock market starts declining because of technical reasons, because of the yen carry trade. That's it's not necessarily economic. It's the yen carry trade or what's going on with Israel and Iran or some other factor. The market was overbought. It starts selling off, and then that starts in. As the market sells off, it affects confidence, and you get this circular motion where people are like, well, the stock market's selling off. We're going into recession. I'm going to, stop buying certain things. And, that's kind of where we're at today. And it helps you appreciate how hard it is to predict recessions until you actually get recession type data. So for now, you got to kind of watch the markets, watch the economic data, and let's just see what happens over the next few months, especially with the election coming up.
So, and there's a lot of debate, of course, going on, back and forth on all these indicators. Are they broke this time? Is this time different? And the odds are no, they're not broken, and this time's not different. But the difference is that we have so much monetary stimulus that's still floating around the economy that's still left over, because it's not just the stimulus checks. It was also the Inflation Reduction Act. It was the CHIPS Act. All these other monetary inputs. Government spending was just absolutely massive, something we haven't seen really since World War II, to such a big degree, and that just has elevated GDP. GDP is still running on a nominal basis around 3%, so we still have to go from 3% to negative below zero to get to a recession. That's just going to take longer to get there. And so, these indicators are all probably correct that a recession's coming, but it's going to take us longer to get there because we have to finish going down the mountain. We started up here at almost 9, 10, 11% economic growth. We're down to 3, 4% now. We're slowly getting there, but it's just taking a long time to get down that mountain to ultimately get to recession. So real quick, another question here, Mike, is about is state tax exemption a big benefit when buying U.S. Treasuries? How do you build a bond ladder and deal with taxes? I'll let you answer that real quick, and I'll have a comment on when we come back from the break.
You just factor it into your situation. If, that extra tax benefit, you factor it into the yield. What is that? What's the difference between buying that and a completely taxable bond? Mm-hmm. And, it's just like dealing with munis or any kind of bond or any kind of investment. You're always looking at the tax situation as well as just a return perspective. And you just want to make sure you put everything on an equal par. So if you're comparing a municipal to a government bond, your first question may be, your first problem may be, well, the municipal bond is lower. Why would I do that? Well, the answer is that on an after-tax basis, that municipal bond yield is probably higher. So you just have to equate everything so it's apples to apples.
Right. And well, I have to wait till after the break, because I was going to say that is that, people tend to put the taxation issue first, and it's actually the last of your considerations. So your first consideration is what's your return going to be, as Mike said, on an equivalent basis. If I buy a taxable bond and I pay taxes on it, but if that yield is still higher than what I'm getting for a tax-free bond, pay the taxes, right? Taxes are not important. They're a function of your total return at the end of the day. So don't build your portfolio just to try to save taxes, because you may be impairing your actual return by trying to save a few theoretical dollars in taxes that you think you're saving because, I have this portfolio of munis that I'm not paying taxes on. Yeah, but you could make an extra percentage point in return. I'm just picking a number if you would have paid taxes. So, don't let taxes ever drive your investment decision. That goes for stocks as well. Do not sell a stock because you're worried about paying capital gains taxes. You sell the stock before it gets into trouble. I can't tell you how many people I've seen turn big winners into losers trying to avoid paying capital gains tax. Focus on the return first. Taxes are part of that total return. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Get ready to kind of wrap it up for the day. Let's get back to some of our questions. Interestingly enough, 2 questions right in a row, Mike. Is it time to add bonds today, or is it time to short TLT?
I wouldn't short TLT. I would sit on your hands with bonds. I think we're approaching a good time to buy bonds or add to your bond portfolio. Again, the markets have been very volatile, bonds included. We were up, 4%? Mm-hmm. TLT was up Friday. 3 or 4% on Monday, right?
Yeah, on Monday. Sorry, yeah.
But it's stretched. And the good thing that's happened through this period is that it broke out of a pretty well-defined wedge pattern. It's broken significantly higher. And now I suspect it'll come all the way back down and retest that breakout, which we're getting close to. And then it can have a more sustainable move higher in price, lower in yield. So, I think you need a little patience here. If you want to nibble, we've come down enough that's okay. Yesterday, there was a really bad 10-year auction, which was not surprising, because dealers really didn't have time to set up for it, and yields were moving around pretty quickly, so investors didn't want to commit to an auction, and the market absorbed it really well. Price went down slightly, but not what you would expect from that bad of an auction. Mm-hmm. There's another auction today, a 30-year auction. So we'll see how that goes, and we'll see how the market reacts. And, it's kind of a bonds and stocks and crypto and the yen, they're all tied together here. So what's good for one is not good for the other, and vice versa. So when you're talking about, do I buy bonds? Do I buy this? Do I buy that? You have to think about it in this yen carry framework, so to speak. And that makes trading in this kind of environment very tough.
Well, and this is, it's a kind of an interesting, issue where we are, right? So what we saw on Monday in particular was, exactly kind of what you would expect when markets are crashing, as they were on Monday. You're down 3%, right out of the gate that morning, and everybody's having to force liquidate to meet margin calls. The first thing they do with their cash is they go buy treasuries with it. That's always kind of your risk-off trade, and that's when we saw that very, very sharp spike in bond prices and drop in yields because of that risk-off trade at that point. So now it's reversing a bit because we saw people kind of, okay, well, maybe the world's not ending and I can go buy some stocks. And we've seen hedge funds who had been selling a lot of stocks going into this correction that started a few weeks ago. They actually were the largest buyers of stocks on Monday. So, they were kind of, basically starting to kind of reverse some of that trade late Monday afternoon. We saw prices come back a bit. And then Tuesday and Wednesday, we saw a good bit of buying. So not surprising. I put it in treasuries, short term, safety trade, sell the bond, now put it back into the market. So, it's always important. And this is why Mike and I both said, like I talked about on Monday, is it's if you're trying to buy bonds, it's too late, right? This move's behind us. You're gonna have to wait for a pullback, and not surprisingly, yields are kind of pulling back to where that new kind of rising. We've been in a very nice rising trend really since last October in bond prices. Yields have been falling, kind of in a stair-step pattern heading down. So we've had a nice downward trend in yields, nice upward trend in bond prices. So all we did was break out of that trend. Now, bond prices are pulling back into that trend, kind of where they should be relative to the slowdown in economic growth, employment, wages, et cetera. So just, kind of getting back into a more normal range. But again, to Mike's point, just, this is going to be a better time to add bonds, but give it a few days before we get there.
And
Go ahead.
Lance, you talked earlier about Eli Lilly.
Mm-hmm.
And Eli Lilly is a very interesting stock over the last couple of weeks because of the yen carry trade. So one of the questions that I've gotten an email a few times now is, why are you so confident this is the yen carry trade and not about the labor report or Israel-Iran or, a whole number of other worries out there? And the gist of my answer kind of stems from Sunday night. I looked at my phone. It was whatever it was, 7, 8 o'clock at night. And I saw that the yen was soaring. It was up whatever it was, 2 or 3 or 4%. And I saw Ethereum was down about 25%. I then looked, the NASDAQ was getting hit really hard. The Russell was getting hit really hard. And you could see that the indices, because stocks weren't necessarily trading yet, it was hard to gauge the full market. But the things that were the most speculative longs over the last few weeks or even week were the things that were getting hit the most. And bonds were flying too. And there were probably a lot of bond shorts that were forced to cover. So when market opens and we look at the stocks that got hit the most, it was the Magnificent Seven, more or less, right? Those were the brightest red. And then there were a whole host of other stocks that were down less than the market or even green.
Right.
And in our portfolio, we own 2 healthcare stocks, Lilly and AbbVie. And AbbVie was, I believe it was green on Monday, or it definitely had a much better day than the market. I think it actually was up on a day. Lilly got killed. Lilly's been trading with NVIDIA, with Ethereum, with the yen, almost 1 for 1, while AbbVie has been going the opposite direction more often than not. So that helps gives you a little bit of clue as to what's going on when you can see certain stocks like the Russell. Until no one liked the Russell until 2 weeks ago, and then it became in vogue to own small cap stocks. And what got hit? What was one of the hardest things that got hit earlier this week? Small cap stocks, because that's where the fast money went. The yen carry trade went. And so we've seen a reversal of that. So you can look at stocks like Lilly, and Lilly will be up 10% today because of earnings. But if you look at 2 stocks in the same, like Intel and NVIDIA, for a while were kind of telling us something similar, that chip makers were moving very differently than each other. And you see it in a bunch of industries. So, I just wanted to double back on that Lilly comment you made.
Okay, no problem. But so one other question here, we got about 5 minutes here before the top of the hour. So one of the questions, and it was a good question, is liquidity indicators. This is something that you and I talk about a lot is market liquidity, because that's obviously what drives asset prices and where's that liquidity going. One thing, we produce a chart on a fairly regular basis, which takes a look at the Fed balance sheet, less the Treasury, the Treasury general account, et cetera. And, that liquidity measure has been declining even as markets have been rising. And normally that's not been the case over the last really kind of a decade that we've entered into this new regime of just, QE and zero interest rates and those type of things. So the market's really kind of has been kind of running its own story as of late. It's really kind of ignoring the actual liquidity. We know liquidity's been getting pulled out of the market. The Fed's been doing QT, not QE. We've had, a lot of issuance of bonds to meet these funding requirements for all these different programs, the Inflation Reduction Act, the CHIPS Act, et cetera. So we've been spending, a lot of money. But liquidity has been actually kind of getting pulled out of the markets, but yet asset prices have been rising. So, it's been an interesting issue that liquidity has been going in one direction. But then if you take a look at, for instance, the liquidity indicators like Goldman Sachs, et cetera, when we talk about eases of monetary policy, reduced interest rates coming down, whatever it is, fiscal easing has been going on because we have this, rise in asset prices. So it's been really kind of confusing for the markets because you have these two different measures of liquidity and fiscal easing kind of going in different directions.
And then I would add to that, there's kind of market like real-time liquidity, which we can't really, which you can measure with things like volatility. So, Lance kind of talked about big macro types of liquidity that are drawing money from the markets or adding money to the markets. But then there's just investment behavior and sentiment. And when you have days like Monday where everyone's fearful, liquidity dries up. It doesn't matter how much liquidity is out there. No one wants to put it to use. So, when you're thinking about liquidity, you have to think about things like bid-offer spreads, implied volatility. Those help give you a gauge on what liquidity is like at that moment. Then you take a step back and you say, well, the Fed's doing this, the government's doing that. There's all these different factors that feed into kind of the broader liquidity. And quite often you can have a gap between total liquidity in the market and actual liquidity that's being used in the market. So, liquidity, no one has come up with a great formula to define liquidity, but liquidity is one of the most important things we can follow, and it's very nebulous.
Yeah. So. And talking about the CHIPS Act, you brought up Intel a second ago, and we'll just kind of close out on this, just a quick comment, but it was interesting that Intel got $8.5 billion from the government for the CHIPS Act, and then they just announced they're laying off 15% of their staff, cutting production, cutting their dividend. Where'd the $8.5 billion go? That's my question, Mike.
It didn't go to me, Lance. I'm still here.
But I think this, but honestly, this goes back to how, we've talked about before is that, the government is the worst allocator of capital. And this is a good example of that. $8.5 billion is going to a company that is getting absolutely decimated by their competitors in the marketplace. Why wasn't that $8.5 billion sent to NVIDIA or AMD or some other chip company here in the U.S. that's actually growing market share, producing what the world wants? That's would have been a much better response. But again, private capital investment is always much better than what the government does with money. So maybe get the government out of business. Maybe that's the right answer. Mike, thanks so much. All right, get by the website, realinvestmentadvice.com. Get Mike's latest article, our recent blog post. We'll have one out tomorrow as well. Our weekend newsletter coming up also. So make sure you're subscribed. We have multiple email lists, so you can just pick and choose what emails you want from us. But take advantage of it. It's all at the website, realinvestmentadvice.com.